My name is Evan Vanderway. Most of you know me. In a room like this, normally half of you or a few more are clients already, and so those of you who are not yet, feel free to, at dinner, mingle with those who are and ask them any questions you would like to about me. That's partly why we do these things the way they do and the way we do them, and some of you make me a little nervous, but I think I can handle anything any of you might say. So that'll be fine. And this seminar, we're going to dive right into it. This seminar is one that I gave probably every month 10 years ago, 9 years ago when we first started, Separating Myths from Truth. It's the basics of investing the way we invest. There are couple of different ways to invest. I'm going to segment those out for you. But this essentially dissects the two ways and promotes the way that I'm looking to teach and create a discipline around for my clients and give them the success that we know the market can give. So getting into it, I'm going to define a few terms because the terms can sometimes trip us up. I did a seminar a while back, and it was kind of right on time. I started on time. I ended on time. I thought my jokes were perfect, and the person ended and said, "What's the S&P 500 again?" or "What's the market?" I kept talking about those terms, and I thought, this whole thing could have been much more impactful had I just defined a few things. So a couple of terms we're going to talk about, and am I in the way? Can you guys all see past me here? Okay, this is where Charlie wants me because we're going to put this on YouTube as well after tonight. A couple of terms that we'll talk about tonight. One is an index or indexing. Now, similar to index or indexing is the word passive when it comes to investing. What that means is that the manager of the money or the manager of the investment is not making a lot of buys and sell trades. Okay? The opposite of passive is active, right? And most mutual funds on the market, high 90% range, are active mutual funds. Most mutual funds that you will run into, the manager is trying to, quote unquote, beat the market. Now, when you want to know what the market is, you have to look at the index. The index tells you what the market is. Some mutual funds, very few, but some, try to mirror the market. They try to own everything they can in the market. And that's what we advocate. I'll explain why as the night goes on and how that benefits you as the investor in many different ways. But what we're looking to do is we're looking to avoid the active side of investing, the buying and selling, which is called turnover. So you have a mutual fund. A mutual fund is an investment that you can buy. It's a company, really, that you can buy. And that company owns many companies. And if you're like me, you're not wanting to look at the list of all the companies you could own and try to buy the right ones, right? So you buy a mutual fund because you assume that that manager of the mutual fund is going to make better company selection choices than you would. And we don't mind delegating certain activities because we don't necessarily want to go online and do all of this, right? So they're doing that for us. We buy that mutual fund, and that mutual fund owns a number of companies. And under the heading mutual fund, you have these two different kinds. You have the passive mutual funds that use these index formulas, and you have the active mutual funds over here that do the active trading where the mutual fund managers are buying and selling. Okay, so this is the landscape, and these are some of the words that we'll use throughout the evening, and so I'm going to go through this. A couple of the indexes or indices that we'll talk about are the S&P 500, Standard & Poor's 500. How many of you know what that represents? Show of hands. The 500 largest companies in the United States. Okay. There are indexes or indices to represent just about any sector. The Russell 2000. Anyone heard of the Russell 2000 before? This represents the smallest 2,000 companies in the United States. And then there's the Russell 2000 value. The value are the lower priced small companies. And when you own an index, S&P 500 or the Russell 2000, you would expect that none of the stocks in the one mutual fund would be the same as the stocks in the other mutual fund, correct? Russell 2000 would be small companies. S&P 500 would be large companies. That's a good thing. We want to diversify. We want to own different things. And so we want to make sure that the mutual funds we own don't have any overlap. I'll talk about overlap. Overlap is when a mutual fund A and mutual fund B are both found in your portfolio, and they both own many of the same companies inside. Right? I did a quick analysis for a client. They had 4 mutual funds inside their portfolio. They were diversifying among these 4 mutual funds, and all 4 of them had the same top 5 holdings. In other words, it was Abbott Labs, a big pharmaceutical. I think there was another one, Apple was in there. Amgen. The top 5 companies were the same in each one of these 5 or 4 mutual funds that they owned, the 4. And so that person didn't find themselves very diversified. They owned 4 mutual funds trying to diversify, and they looked inside the mutual funds. They found a lot of overlap. So these are some terms that I'm going to use. I'm going to go through the presentation using these, and I wanted them to be a little bit familiar. Separating myths from truth, the story of investing. We're going to go through 3 components: dispelling the investing myths first, telling the academic story of investing second, and then give you an opportunity at the end, and that will probably come at the end of the night. I'll have you fill out a card to know how to access me. So separating the myths. Let's define myths first. A myth could be defined many ways. We'll define it this way: a story that we make up to talk about something that we don't have the science for. We don't have a better way to explain it, and so we make up a story to talk about it. The example I use here all the time is the example of the Earth, for a long time, being the center of the universe. That was what it was in many people's minds. And we didn't have any information until Galileo or his predecessor came along to determine otherwise. It just looked like the sun came up over here and it went down over here. I didn't feel like I moved, so it must have been that the sun did. And it sure feels like I'm in the middle of everything, and so I must be the center, right? That was the myth. The Earth is in the center, everything revolves around it. Well, it is a myth. What I like about this analogy, though, isn't so much that, yeah, that's a myth, and there are myths about investing. It's that the institutions of the day, back when Galileo was trying to show people the truth with mirrors and prisms, the institutions of the day, and that time the church, was pretty vested in keeping the general society believing their myth. They had a lot wrapped up in it for whatever reason. Now, I think they recovered well, right? We shouldn't be so negative about some new information coming out, but they were pretty wrapped up in it, and they banished him from the church. I think they call it excommunication. So Galileo didn't fare very well, but we all did once we learned the truth. And that's what we'd like to do tonight. The first one through the wall is the one that gets bloody, I guess, and that was Galileo for us on that one. But there are some common investing myths as well, and they come around 4 basic components. Stock selection, and in your book, if you want to open this up, you can follow along. Some of you are follow-along people. Some of you may want to take notes. This is on page 3. I fly now and again. I go to a conference or 2 every year, like some, and I end up in a seat next to somebody that I don't know generally every time I do that, and quite often it's, what do you do? I do this. What do you do? Where are you from? Where are you headed? All of that goes along with it. And generally they ask me what I do, and I tell them I'm an investment manager or I'm an investment advisor. Sometimes I'll go for investor coach, and I'll see where that lands, right? And, oh, wow, that's interesting. Well, they'll generally start asking me questions, and it's usually not necessarily in this order, but along these lines. You know, what's a good company right now? What are you watching? What's a good stock? And I'll say, well, I have no idea. No idea. Okay. You know, if they have some guts, they'll come back and they'll do another one. You know, if they know something about investing, do you know of a good manager right now? Who's a good manager? You know, what's his name from PIMCO just left and went to Janus Funds? You know, they'll try to, who are you following? You know, who's a good manager? We're talking about track records. Who's got a good track record? I say, whoa, no idea. And if they have, you know, if they're really going for it, they'll ask another question. Then they'll usually throw me a softball. You know, should we be in the market or out of the market? Sure, he should know this, right? He's an investment advisor. He's a big coach, right? So let's just ask him if he can just tell me, should I be in the market or out of the market at this point? And I say, wow, I don't know. I have no idea. And by this time, they're just wondering if I do what I do for a living, if they even know what that means. But there are lots of myths surrounding this, and I'll show you a lot of evidence that these are myths. The 4th one is cost of investing, which you can't see can hurt you. I'll show you that. But when people ask me what I do, or they find out what I do, and my clients are looking at me and saying, hey, I'm entertaining the idea of using you. What is it I'm supposed to expect from you? 2 years into our relationship is the last time I want you to find out that I'm not picking stocks and tracking, you know, track records of 5-star funds. I want you to know right here up front before you make any decisions, right? So that's what we're doing. We're just going to show you in good evidence form what we believe and why we do what we do. So myth 1 is stock selection. And stock selection essentially is this, that we choose stocks or we pick stocks based on a belief that they'll do well in the future. And so far, so good. I own stocks in our mutual fund for our clients. We own nearly 13,000 stocks, and we own them because we believe that they will do well in the future. No myths here. This is just the definition. The myth is that investment advisors, me, or money managers, mutual fund managers, can effectively and consistently add value through stock selection. So when I talked earlier about definitions, we talk about beating the market. Can a mutual fund manager, or if I built a portfolio of stocks for you, could I do better than the S&P 500? It's a good question, right? Because you're undoubtedly going to pay me more to manage a group of stocks. You can buy the S&P 500 for 10 or 15 basis points, so 0.15%. You can own that fund and get its benefits and pay almost nothing for it. I mean, it's a formula. Nobody decides other than, is GM still one of the 500 largest companies or not? If it's not, it gets sold. It's not an emotional thing. It's not personal. It just isn't. And so we sell it and we buy the one that just flipped in. That's an index fund, right? No human being is looking at the fundamentals and, oh, that manager just, came out and said they, think the economy is going to go down, and so maybe we should do something different. No one's analyzing anything. It's just an index. If it's the 500 largest companies or the 2,000 smallest companies or one of the other 18 indexes that we could use. But an investment advisor using the stock selection method believes that they can beat the market. That's why they're buying and selling inside your mutual fund. Now, along this point, we talked about turnover a little bit. Turnover is defined again as buying and selling inside of a mutual fund. Any idea what the percentage of the average U.S. mutual fund in 2013 was turned over? Over 70% of the stocks inside the average active mutual fund were sold and another set were purchased. That's a high level of trading. This is a manager of a mutual fund that believes that they are the ones that are going to create return or value for you. They want to beat the market by just enough to give you a better return and take their additional pay out of the middle. And if they can do it, great. I'd rather get 11 than 10. The S&P gets 10. If this guy can give me 11, or this team of people can give me 11% net of their fees, why wouldn't I want that? 1% in a mutual fund is pretty good over time, right? But we look at the evidence, and the evidence doesn't say that they can do it. First of all, the evidence isn't really all the evidence. I don't think this one's in your book, but this is called, this is a chart that talks about survivorship bias. In 1923, the first mutual fund was born. And then in 1924, there were 4 more. And then 26 or 7, we started to get good stock data, and more mutual funds were born here. I'm sorry, 3 more, total of 4. 1 more, total of 5. New mutual funds started coming in just about every year. Now, it was in the 60s then that we started to see mutual funds die. None of them died until 1961. There was a mass extinction event of mutual funds during that period of time. And then it became commonplace. Late 60s, just about every year, a growing number of mutual funds would die. Now, that's remarkable from a couple of angles at least. Number one, the mutual fund you own may not exist or may not have the right to exist. You may have to sell it if there's anything left after a period of time. And number two, once a mutual fund dies, the returns data no longer appears anywhere for you to see, especially in the prospectus of the company that you're entertaining working with. So they kill a mutual fund, and they no longer have to put that mutual fund's return in their prospectus, right? So over the years, there are currently 30,500 funds. That was at the end of this last year. There are more again. Total number of funds born were 54,000, and the total number of funds killed, 23,778. Now, I'll admit, funds are killed for lots of reasons. A new name of a fund is more marketable these days than the old name. They'll kill a fund. It didn't necessarily perform badly. It just was hard to sell given the change of culture or society. I mean, you can make up 100 reasons. They're probably all right. But the worst 200 dead mutual funds lost or were dead for pretty obvious reasons. Their cumulative total return was negative 80%. And it doesn't get better fast on that 23,000 dead list, right? Now, this data is no longer in the data that you can find anywhere. Unless you have a degree or a license to go to the Center for Research in Securities Pricing, CRISP, in Chicago, you go down there, you can get this information, which we did, and we put it back in the numbers. Okay, so the slides I'm about to show you have all the data, not just the 30,500 funds that are left, but all the data from the last, long period of time. We'll look at very long periods of time, 40, 50 years. It's all going to be in here. So what we looked at first, and this may be in your book, we looked at all U.S. equity funds. So this is in your book. It's page 4. U.S. equity funds. So define that out. That means the stocks inside these mutual funds are all U.S. companies, and they're companies' stocks, not bonds. Okay, so these are equities, not bonds or the debt instruments. They're stocks, and they're in U.S. companies only. And we put $100,000 in various types of indices back here in 1973. I choose 73 and 74 for starting points for lots of applications, for the main reason that 73 and 74 were two very down years. So we generally always start our series with negative years. We're cherry picking for bad times so that you can kind of look at what that would feel like, right? So 1973 we start this, and the number here, average U.S. mutual fund on the left, is the average of all mutual funds that dealt with stocks only in the United States that you could have owned, whether they were bought and killed. The end of the period of time, you would have owned about 15,000, 20,000 of them, just the U.S. ones. You would have bought and sold them here, or bought and some would get killed. You'd acquire the new ones when they came in. And at the end, $100,000 equally distributed among them would have turned into $2.7 million. Pretty darn good, lots of money, 41 years. But if you just owned the S&P 500, partly because the fees are less, and mostly because the S&P 500 never really buys and sells. It just owns them, isn't making bad trades, isn't trying to time the market, isn't trying to get out at the right time and in at the right time and making bad choices along the way, is never getting lucky, which some of these did at times, but as you can see, obviously not enough times, because the wealth lost to active stock management was still $2.3 million when you average just the S&P 500 against all of the mutual funds you could have chosen on average. So this is not good. Active stock management or stock picking on average doesn't tell a good tale. Now, go one more slide before you kind of go where you're going in your mind. Where I went in my mind, and some of you already are, okay, Evan, I would never use the bottom 200 mutual funds. I'm going for the top 200 mutual funds. I'll go there. Okay, so we'll talk about track records in a minute, but follow me for the next one. This next set of graphs, and is on your other side of the page, this shows you the average of all mutual funds. So at the end of 2013, you would own that 35,500 mutual funds, and you would have $1.425 million in equally distributed among those 35,500 mutual funds. Now this would be stock funds, this would be bond funds, so it's the aggressive and the conservative. This would be here and abroad. This would be diversified among 45, 46 countries now, probably by now. And it would be in emerging markets, it would be in developed markets, it would be here in the U.S., and your $100,000 would be worth $1.425 million. And you would expect it to be less than the 2.7 because here it also owns bond funds, right? It owns the conservative stuff too. And probably half of each, pretty much. Our conservative mix of assets, this would be a fund that would have grown to 3.0 million and only has 25% stocks in it and 75% fixed income short-term bonds. This would be our most conservative fund. It barely went down in 2007, 8, 9. It went down 3 or 4%. Some of you experienced that, and you were fine because you said you were conservative, so you didn't lose any money. Some of you were 28 or thought you were, and you were here, and you lost quite a bit. And then in about 2 years, 3 years, you had it all back again and then some. But that aggressive account, which is all stocks, $15 million, $100,000 would have grown to 15 million over a 43-year period if simply invested in alone in those indices. Now, back up a little bit. It costs money to invest. I'm looking at indices here only, not looking at commissions here, not looking at commissions here. So all these numbers would be scaled down just a little bit for cost, maybe some active funds more than others, but we're giving them all the benefit of the doubt and removing all the costs from all of them and giving them all the very best they could possibly do without cost. And this is the difference, or the wealth lost to active picking. Active stock picking with mutual fund managers results in lower returns over long periods of time for investors. And they are they're very much, along with what's given them in the law, they're going to present their information very much in a positive light. They're going to give you the information in a way that makes you feel like, yeah, they've done better than they may actually do for you in the future, right? So stock picking doesn't work on average. But the question I asked right away was, I don't need it to work on average. I just need it to work for me. And so I want better information, right? So the second issue is track record investing. And track record investing is the use of performance history to determine which funds may be of benefit for me to purchase going forward. Now, the myth about track record investing is that finding funds that did well in the past is a reliable method of finding funds that did well or will do well again in the future. And you know, in every investment article and every investment prospectus that you've ever read, it says past performance is not indicative of future results or is not a predictor of future results. That is true, and they have to always say that, and yet we want to show you that the myth is finding funds that did the best in the past or well in the past is a reliable method of indicating which ones will do well in the future. So this is in your book again. This will be on page 6. And here we have U.S. equity funds. Okay, so we have a list of funds that did well. And I have a list here from 94 to 2003. You'll see in a minute why I chose this 10-year period. We have done this presentation. I've done it personally for almost 10 years, and we've been doing it as a group of advisors for more than 20 years. And every new year, we drop a year off the back, and we pick up a new one. We just want to take 10-year increments, and I'll show you one in 5-year increments, because that's what Morningstar uses. Morningstar hands out awards for 5-star funds that have beat their market index for 5 or 10 years. So we just use their same periods of time. And from 94 to 2003, there were 30 funds that did better than all the rest. These are U.S. equity funds. They're U.S. equity, so you would compare them to either the S&P 500, which are all 500 of the largest U.S. companies, or what they call the CRSP 1 through 10, Center for Research and Stock Pricing, Securities Pricing, 1 through 10, which is the small companies and the large companies and everything in between. And you would compare to those. And this set of mutual funds did 17.38%, and the S&P did 11, CRSP did 11. And those winning funds did very, very well. And I'm looking at it and saying, hey, I don't need to use those 200 worst funds. I want to know how and which funds did the best. So I'm going to build my portfolio using one or two or 3 or 4 or 5 or 6 of these top 30 funds. Right? That makes more sense. I don't know how else to pick a mutual fund if I'm looking for a mutual fund to beat the market than choosing one that already beat the market, right? If someone else has one, raise your hand if you have another method. But this is, if I'm looking to beat the market, I need to find out who beat the market recently. And another observation, which is probably very obvious, is that they didn't hand you this list here in 1993, correct? They don't have a list of the top 10 mutual funds or top 30 mutual funds for the next 10 years. Now, Money Magazine will tell you their top stocks and mutual funds for the next 10 years, but they're never right. But again, they're not necessarily money managers, they're advertisers. So let's forget Money Magazine. Let's look at the actual mutual funds who beat the market. And again, you received this list in 2003, and you want to own the fund for the next 10 or so years. One more observation. You're using this list and you're conditioning yourself in a certain way. What do you want for the next 10 years? Do you want to get the S&P 500 return? No, you want to do better than the S&P 500, right? So you're conditioning yourself. You're using the ones that beat the market. They just said they can beat the market, and they're selling you their funds because you believe they can beat the market again in the future. This same set of mutual funds did 7% the next 10 years, which shouldn't tell you anything until you figure out what the market did. The market did 7.41. The market with small companies in it did 8.23. Now, the problem with this isn't so much that you would have been fine in this 10-year period. This happens to be a 10-year period where you'd have been pretty well okay compared to the market. The problem is you still would have been disappointed and sold, right? They underperformed. And you probably would have done it long before 2013, and you would have jumped on another bandwagon. The average investor lasts about 3.4 years in an investment strategy before they move or finally see the light or have experienced enough pain to make a change. So Large, small, mid-cap companies did 8.23, and it's a whole lot cheaper to find and buy this set of funds than it was to own these, which is part of the reason why that one did so poorly. 1,600 funds lasted this entire 10-year period. 4,100 funds lasted this entire 10-year period. And now we look at another section. So you look at your next page. I think it's page 7. We're going to use 5-year periods of time. This is much closer to what the average investor is being conditioned to do. Go in and talk to your 401k consultant or your advisor every 3 to 5 years and in a serious way make some changes. Well, the top 30 funds at the end of 2008, a pretty key period of time. So 2004 to the end of 2008. 2007, October was the peak before that big crash. The crash didn't end until March of 2009, but by 2008, 12/31 or December 31, it was pretty abysmal, right? Pretty crummy. And if you were hoping not to lose, even if the market lost, you'd be looking at this and saying, hey, my average return in an S&P 500 fund was negative 2% per year. That's an average annual rate of you lost money on average. You went up for a few years, then you went way down in 2008. And now you're being faced with a set of 30 funds that averaged 4.58 during the same period of time that you've been having a negative return. And that sounds pretty good to you. And so you switch out and you say, hey, these are the winning funds for a 5-year period. I'm going to own them. And you did 6.24 for the next period. And the S&P 500 did 18% per year during that period, 2009 to 2013. So this is actually what generally we see a little bit more of. And it's the reason the average investor is getting somewhere between 3 and 4% rate of return in their cumulative internal return in their investments. Because they're chasing after that hot sector. They're chasing after the returns that have already been posted, and they're getting in after the market went up. Incidentally, inside of a 401k plan, and this is why I offer as part of my service to my clients to manage what's inside their 401k plan or help them do it when I'm not able to actually take over what they're doing there, because otherwise, they're generally looking at making a change of their 3 or 4 or 5 mutual funds every 3 to 5 years, and their 401k provider is actually giving them a new set of options every 3 to 5 years because the 401k investment manager is trading out the funds that did poorly and putting new funds in. So the plan administrators, the owners of the company, they're getting this information. They're putting new funds in. The employee simply has new funds to choose from, and they almost have to do it. And so we're trying to educate back up the chain in 401k plans to make sure that the human resource departments are at least offering a few index funds for the employees to purchase so that they can get out of the rat race. But this is what happens, and this is what most investors are falling prey to, is this annual return of past years, 3 to 5 years or 5 to 10 years. And this is the truth. This is actually scrubbed a little bit for compliance. The compliance police are getting really bad in my industry. A manager's ability to pick stocks in the past has no correlation. Okay, little to is a couple of words in there that my attorneys make us put in this slide. Little to no correlation with his or her ability. There really is no statistical correlation between a past performance of a mutual fund and their ability to do well again in the future. There just is no correlation from one to the other. So the only thing you can really trust on the bottom of the investment statement sometimes is that the past performance is not a predictor of future results. A manager's ability to do this doesn't compute and it doesn't go forward. It's a good thing to remember. Myth 3 is market timing. If the previous myth, track record investing, affects more people, and it does, it probably affects more people through 401k plans, market timing can affect someone the worst, probably. This would be that changing of a mix of assets based on a prediction about the future. My favorite story here just happened again, I think in 2012, when we were all falling off the fiscal cliff. You remember the fiscal cliff that we were all going to die on? Going over the edge. And the fiscal cliff was going to kill us all and our investments, and we were told to get out of the marketplace, and especially Greece, because Greece was really hitting the skids, right? And in 2011, Greece was having a hard time. I think they actually went bankrupt, didn't they? And they got reorganized. And I kept telling my clients, we don't own Greece. We own Greek companies, we don't own Greece. In 2012, the S&P 500 was somewhere in the teens, I think like 16%. The Greek stock market went up 30% in the year that Greece was reorganized and went bankrupt. So we were buying Greek stock because in 2010 and 11 they went down. And as they went down, our portfolios became underweighted in the Eurozone. And so we were buying them because that's what we do. Not because we were emotional, not because we thought, wow, Greece is going to go up in a year. We didn't know. It was simply less of our portfolio than we promised you we would own. And so we bought them. And then when they went up 30%, guess what we did? We sold them to everyone else that was clamoring to get into Greece and own their stocks. We were happy to give you a few shares of ours because we were lessening our portfolio as it was growing. And it's not because we're predicting anything. We're not trying to be smarter than the market. We're simply saying history says we don't want to own too much. We want to own this much, and so we keep the mix where it needs to be. That's market timing, trying to change your mix of assets based on a prediction in the future. The myth is that money managers are able to do this and add value to you, and it is a myth. The S&P 500 index, over a very long period of time, this would be what, 40 years, 30 years, has 11.10% average rate of return. The average investor using equities, and we know what investors get because equities are publicly traded, so we know what investors are doing when they're buying, when they're selling, the total return they're getting while they own. The average equity investor gets a return of 3.69%. This is probably the most used slide in my industry. Now everyone has to have an answer for it, right? And tonight I'm giving you my answer for this problem. This is the problem in investing. You're getting this. And we want you to get that. We want you to get the market. Inflation is about the same as that return, and so you're not making any money if you're doing average. Here's the reason why we can't market time effectively. If you put $10,000 into an investment account, the S&P 500, and stayed invested from 93 to 13, so this would be a 20-year period, 5,040 trading days. If you just left the investment, $10,000 in the S&P 500 during that period of time, it would have grown to about $55,000. And if you missed the 5 best investing days during that period, you would have cut your returns by 16,000. 5 total days out of 5,000. Now this is illustrative only. No one's going to be that unlucky to miss just the 5, right, best days. But it does give you a sense for the volatility of the market. All the returns are coming in about 20 days. You missed the top 30 days and you basically didn't make money. 30 out of 540 days, absent all the others, is where all the return came from of a $10,000 investment. The rest of it's just what you have to endure in order to get the $55,000. Really, let that sink in. The rest of it is just what you have to endure in order to take your $55,000. Now, if you're the owner of a company and you're selling shares of stock, why are you doing that? You need money for something, right? And there's 2 ways you can get it. You can borrow it. There's only so much of that you can do. Or you can sell portions of your company, equity, and someone else can own a portion of your company. Now, if you're a company owner and you lend your money to an investor, you're going to pay them 3%, 4%. And if you go bankrupt, you're going to pay them out of your own checking account because a bond or a debt instrument is a guaranteed instrument. If there's money there, you're going to pay those investors. But if you sell portions of your company to an investor through stock and you go bankrupt, what happens to the investor? This is why we don't own one company. We own 13,000 companies, right? You go bankrupt with the owner. You're an equal share. Well, what does that capital cost? Right? This is a cost of capital story. That's what this is. The capital for borrowing money costs between 3 and 6%, depending on the strength of the company. The capital for owning equities, depending on the company, if it's a large company, the cost of capital is about 11%. If it's a small company, the cost of capital is about 13%. Now, when the market goes down in 2008, do you want to give that business owner the ability to buy your stock back without giving you your return before you sell it to them? Don't do it. Get your entire return, sell long into the future, sell slowly, right? Sell methodically. Get your return, because these business owners who are selling you parts of their company through our mutual fund, they're prepared to pay you between 10 and 15% for your money. If you're willing to endure what it takes, that's what they're willing to pay you. And then you can sell them for that return in the end, or sell back to them for that return in the end. Don't sell it to them beforehand. Does that make sense? This just makes sense. It has to make sense. And capital costs money. And with risk and with the size of companies factored in, capital can be pretty well ascertained. Beware of tactical asset allocation. I'm a part of a number of little news feeds in the financial industry, and it probably a week doesn't go by when I don't hear about tactical asset allocation. You see the word tactical next to asset allocation, and you can no longer trust what they're doing with asset allocation because they said tactical or strategic or something like it. Shifting between two asset classes, whether I'm in the market or in bonds, is hard enough. Shifting among asset classes, small companies, small value, micro cap, large U.S., large international, large developed markets value, whatever these different classes may be. But for them to say then, I'm going to come out of Greece and I'm going to go into U.S. small because we really think that's where it's going to happen. That's tactical asset allocation. It is market timing, and you can lose. It's kind of like Russian roulette with one bullet in the chamber and Russian roulette with 3 or 4 out of 6 in the chamber. I mean, you're going to lose faster with tactical asset allocation. So don't, just because it has these 2 words in it that are actually pretty good, don't be fooled. Tactical asset allocation is market timing. Harry Markowitz, Charlie Ellis, says the evidence on investment managers is in, it's impressive, and overwhelmingly negative. So let's talk about costs before I move to something more positive. Costs are the fees that you pay to own mutual funds or other types of investments, mutual funds or stocks. The myth is what you don't see can't hurt you, and it can. The most prevalent fee that you don't see is called the bid-ask spread. I talked about turnover of mutual funds. Every time a stock is turned over, there's a spread between the buy price and the sell price, and the market maker keeps that. I'll illustrate that here in a second. Mutual fund expenses like expense ratios and 12b-1 fees, those things we have to all be added up. We try not to pay those if we can help it. If I want to sell a stock, maybe the price is $49.50. If I want to buy a stock, the same minute, the buy price would be slightly higher, and the difference goes to the market maker. It's called the bid and the ask spread. The market maker gets the 50 cents. If I wanted to buy a share of Nancy's stock, said, Nancy, I'll pay you $5 more than IBM is selling for right now. Would you sell me some of your IBM shares? You wouldn't be allowed to. That would be an illegal sale. It has to go through a public market. It has to go through a market maker. You can't sell me that stock directly. It's a good system. I like the system. The system simply tracks prices, and the market maker gets paid to perform a service, right? And the spread, if the companies are large, so if companies are larger than $5 billion, the spread is very small. These are companies that are easy to find. You can trade them just about anywhere, probably 10 different exchanges within driving distance. And as the companies get smaller, this is where the best returns are, the spread on the buy-sell gets larger, so it becomes more expensive, especially you get into these emerging markets, you get to South Africa, you get to different countries and parts of the world that have only had markets for a decade or less. It becomes pretty expensive to buy and sell those. You don't see too many active funds buying and selling in small company emerging market sectors. Those are usually buy and hold type, which is good. But this bid-ask spread is a costly venture, especially if you remember I said that bid-ask spread is paid on turnover. The average mutual fund is turned over about 70%, maybe a little bit more. That's a pretty high cost. The estimate is over 30 times. That's for the smallest. So smallest companies cost more. And Charlie Ellis again says the key questions under the new rules of the game are this. How much better must an active manager be to overcome his cost and to give you a return that beats the market? The answer is daunting. Oftentimes, the total costs that I find inside of a total portfolio, I've seen them as high as 5%. On average, they're between 2.5% and 3.5% when you add in these hidden fees. They're real costs of investing. And what you don't see, that bid-ask spread, you just don't see it. It's the difference between the buy price and the sell price. It doesn't list out anywhere. It's not there. It just kind of vanishes in the middle. What you don't see can hurt you. So far, we're were fully unimpressed, the guy sitting next to me in the plane, and hopefully gave, if I had my PowerPoint, that's what I should do. I should just get my PowerPoint out. Well, let me show you what I do, right? They'd probably put their headphones on pretty quickly. But we've shown you why my answer to these 4 questions is I don't know, right? Because I don't know which stocks are going to do better than another, and I would never build a portfolio based on it for you, even if I had a guess. I just would never do it. I'm not going to try to guess when the market's going up and down, and I'm not going to try to guess based on a good track record. So what we want to talk about are the academics of this. I want to make a good decision based on the academics. And we call it Mattson's free market portfolio theory. Okay, so free market means markets set prices. Portfolio theory is something I'll get into in brief here. It's an investment approach based on 50 plus years of research and data, and it's a disciplined approach that seeks to capture market returns while minimizing risk for you, the investor. And there are 3 components to understanding it. Free markets work is the philosophy behind it, and then we have modern portfolio theory, which is the theory that it's based on, the school of thought, and then the 3-factor model, which is the practical outflowing. I think this is in your book as well. So Harry Markowitz wrote the paper in 1952, and in 1990 they had enough computer power and data to give him the Nobel Prize and prove that he was right. And Merton Miller did that paper with him, and they both won the Nobel Prize. Rex Sinkfeld and his partner Roger Ibbotson were both at the University of Chicago for many, many years. We stand on their shoulders as well. Eugene Fama, he was just given the Nobel Prize for his 3-factor model and the profit model. And then Ken French worked with him as well. These are the academics that we follow. If Eugene Fama says there's premium, we tend to look at his research and then agree with him. Free markets work. This is the philosophy. So the top level. In a free market, the best indication of a company's value is its current stock price. Now, it doesn't mean a stock might not move up or down tomorrow. And was yesterday's price wrong? You could argue maybe yesterday's price was wrong. Maybe new information that just wasn't out there yet shifted the price the next day. You hear this on the news. Wells Fargo was just downgraded to a sell, or Bank of America was upgraded to a buy. Right? You hear that on the radio. What does that mean? If a stock is upgraded to a buy, that means investment advisors are looking now to purchase it, where they weren't before. What that means is they believe the value of the company is higher than its current stock price. Okay? We don't make decisions like that. If a stock price is $55, we say the value of the company is $55 today, and only new and unknowable information will change that price tomorrow. That's just plain and simple. Now, we know prices are going to change daily, but only new and unknowable information change them, and information comes in instantly into the market. If Janet Yellen, who's the new Alan Greenspan, that wasn't Ben Bernanke, had so many Fed chair people, right? They come up to the microphone and they tug their ear wrong or they cough, and the markets move, right? This is information. We're constantly looking for information, and the markets will move. Only new and unknowable information can move markets. But look at the contrary belief. Free markets fail. If the markets fail to price goods and service efficiently, then it's possible for individuals to identify in advance which prices are inaccurate. Underpriced or overvalued markets can be forecasted or predicted. Managers then could seek to increase returns or avoid losses by taking advantage of stocks' mispricings. And if you held this view or belief that markets don't set prices efficiently, then you would use traditional investment strategies or approaches. You would have to use market timing, you would have to use stock picking, and you'd have to use track record investing. They're the only ways you could go if you believe free markets fail. But if you believe that they work, then they're the best determinant of prices. It's based on supply and demand. Available information is factored into the current price. Only new and unknowable information changes the future of stock prices and everything else. The randomness of the market makes it impossible for any individual or entity to consistently predict prices and capture additional returns unrelated to risk. And if you had this view, you would utilize a free market investment strategy, which is what I want to show you, because we believe that beliefs dictate your action. You start with that belief. You want to focus on capturing returns, eliminate investment strategies that don't work, utilize asset class or structured funds, diversify, identify your risk tolerance, work with a coach who's going to keep you disciplined over the long term to this strategy. And if free markets fail, focus on the active management side, pursue traditional investment strategies, stay connected to multiple sources of financial information as much as you can possibly find. You don't want to miss something. Or work with a financial professional who will do that for you and get you in and out at the right time, you hope. So that's the philosophy up front. The theory goes like this. Diversification works. Nobel Prize winners, Harry Markowitz, William Sharpe, Merton Miller. He wrote the paper in the 50s, and he essentially said this: you can own one sector of the market, and you can get a 10+% rate of return, and you can have a pretty high standard deviation of risk. High standard deviation of risk simply means that you're going to see a lot of this. It's going to go up and down. 2008 was a big down year, 38% in the U.S. stock market, and pretty high volatility. But again, if you endure, you get a nice return at the end of the day. What Harry Markowitz showed was that you can actually get that return for a lot less volatility if you diversify among known asset categories. And here's a quick rundown of why he focused here. He determined first that market timing, other factors, and stock selection were a very low percentage in the determination of stock prices, and that almost all of the determination of stock returns came from asset allocation. So he focused there. And I'll give you just a quick picture. This is too perfect, but we actually saw it this year. I met with one of you this afternoon, and we just saw it. Large U.S. companies this year, even after the last quarter, are still up 8%. U.S. small companies are down 3 or 4% right now. But in the end, if you own them both, you'll do pretty well. Okay, so if you can own investment A and investment B in equal parts, and they tend to act dissimilarly in their price movements, right? They have what they call low correlation, one to another. High correlation would mean they do the same thing. Low correlation means they act dissimilarly. Well, we know after 50 years of research what these different asset classes tend to do. We know what investment A and investment B does. So I'll show you an example. You look at just the S&P 500. You're going to have a 17% high standard deviation of risk and an annualized return of 10.5%. You simply add international, Europe, Australasia, Far East, 30%. You increase your return and you decrease your risk. Pretty significant. You bring in international small and you pop your return up to 11.06 and you further decrease your risk. International small companies by itself is far more volatile than the S&P 500 is. All by itself, its standard deviation of risk is higher than U.S. large companies. But together with them, because of this, you have a lower standard deviation of risk, and if you can come up with something that cool, they will give you a Nobel Prize too. This is really exciting for a guy who's in my position, because now I have something I can share with you that actually seems beneficial, right? Not I think or I hope or, please don't leave me. It's, hey, we know what we're doing and why we're doing it. And this starts to lend credence to what we're doing. Now we get to the street level and we say, okay, where do we get these premiums? Well, we get the premiums from the market over the bonds. We get the premiums from small companies over large. And we get premiums from value companies or low price stocks over high. Real quickly, if you want to be in the S&P 500, you know that it's riskier to do that than it is to be in the bonds. But you know also that the S&P 500 gives you a rate of return that's much higher than T-bills. So, to a degree, you want to be in the market. Even my most conservative clients are in the market at least 25%, and they can handle that. You want to be in small companies. All of my clients are in some amount of small companies because small companies have a higher return than large companies. There is more risk, but again, it's defined. We know what the correlation levels are against the other asset classes. And the gross return of the S&P 500 is 10. You get almost a 2% premium to own small companies. All right? You guys can bring that food out too, Hyde, if you want, and then we'll be ready. Yeah, be great. I'll be done at 5, and then we'll eat. All right, so then we have high book-to-market or value stocks. And this gets a little bit complicated, but value stocks are lower price stocks. Growth stocks are higher price stocks. And believe it or not, value stocks, Kmart's, do better on average than growth stocks, Amazon's. On average, they do. Their premium's about 2% again to own them. Now, you don't want to own a mutual fund of 15 value companies and build it like Bill Gross did, owning and buying more Fannie Mae and GM and Chrysler all the way down the hill. That's how he made his money in the tech era, picked right, and lost 87% in the 2008 era. He was right once, bought his fund, lost big time the next time. Just his model didn't work the second time, right? But on average, value companies do very, very well. You pay a little bit more in risk for it, but again, that correlates and you'll get the premium. So we want to take risk, but we want to take risk where we get rewarded. And what the previous 3 slides just showed you is that stocks over bonds reward you, small companies over large companies reward you, and value companies over growth companies reward you. So let's build a portfolio with what we know over the last 50 years is going to give us reward. So this is the academic approach all told. Free markets work to set prices as a theory. Modern portfolio theory works as Harry Markowitz developed it. And then the 3-factor model works as Eugene Fama and Ken French developed it into Matson's free market portfolio theory when you put it all together. So building a portfolio, we'll go through this last, and then I will move us toward dinner. And this you could write in if you want to. This is interesting to take home. And you get to page 17. Portfolio 1, or the portfolio I find clients in, we'll call this one. And I used to think it was a little presumptuous to say the average investor is always getting 3.69, and that means the person across the table from me probably is. But I will tell you that it is true more often than not that that's the case. And so I start with this. And again, the reason the average equity investor is achieving 3.69 in an environment where the S&P 500 does much better is because their holding period is less than 3.5 years. They do track record investing and chasing the market, active stock picking, and market timing. These are the reasons why investors are doing relatively poorly against the market. So the first decision to make is to stop market timing, stop stock picking, and go into the index side, the passive side of life, and own that. And that will give you a portfolio. Now we've gone back to 1970, a portfolio 10.4%. and 16.94% standard deviation. Now here, the reason I went to 1970 is because it's the earliest year we have good international data, so I'm not trying to cherry pick here, I'm just trying to be illustrative. Now, the first thing we do is we ask that market question. How much of the market can we handle? And just so you know, we're not going to paint you with any brush here tonight. You may not be a 60-40 person. You may be more stocks than that. You may be less. I'm just choosing 60-40 for an illustration tonight, okay? So we have many different portfolios. Almost every client has one of their own. And what we're going to do is we're going to sell off 40% of the stocks, and we're going to buy 5-year intermediate term bonds and 1-year short-term bonds. Make a note, we only buy short-term, high-quality bonds. When we own bonds, the bonds are fixed. They don't go down. If we want return, we go to stocks. We know where we get return. We don't go to long-term bonds. We don't go to junk bonds. We don't own bonds in Detroit. Okay? Bonds of many kinds can be very scary. We own the short-term, high-quality kind because when you say you want to bring in conservatism or less volatility, the only place we can get it is short-term, high-quality. That's where we go. Okay? So good plug there for what creates stability in a portfolio. Well, you can see what happened is that the return went down just over 1%, but the standard deviation of risk went down 6%. Pretty big deal. And you might have thought that the return sacrificed for 40% bonds rather than stocks would have had to have been higher than 1%. But remember, the bonds do get an average rate of return of 4 or 5%, so that's not nothing, and they still contribute. So then we go to portfolio 3, and we continue to divest and diversify. We split the U.S. stocks into U.S. and international. So now we're 30% here and 30% abroad. That does raise our return just a bit, and it drops our risk just a bit, as you saw in the previous slide. And then we move to small. I put a little small U.S. and a little small international. That brought our return up again, as you'd expect, and it did not bring our risk up too much higher. So you can get those entered in. Portfolio 5 brings in the value companies. U.S. small value, U.S. large value, brings our return up to 11%, and that brings our standard deviation of risk actually back down to 11.0%. Almost everyone I meet wants stock market returns with bond market risk, right? That's what we want. We want stock market returns and get me out before the big dive. It's not possible. You cannot get it. It's a cost of capital story. You have to endure certain things. Now, academics have taught us that you can be smart about it, and you can actually increase your return and decrease your risk if you do it academically and you remain disciplined and you hire the right people to put this together for you. But you can't beat the market. So creating a free market fund portfolio, the U.S. free market, I'll leave these up here a little bit. I don't know if these are in the new booklet yet. On the next page, I think I moved right to the 20 questions. You can look at these during dinner.